Hi and welcome back. We're going to see the fundamentals of bond pricing in this lesson. In the previous lectures, we saw how fixed income markets provide a platform for issuers like governments, corporations, municipalities, and financial institutions to raise capital while offering investors predictable returns and risk mitigation. We explored the market's intricate workings, detailing the diverse participants involved, such as issuers, investors, underwriters, brokers, dealers, market makers, rating agencies, and regulatory bodies. We also examined various trading mechanisms, including OTC markets, electronic platforms, and securities exchanges, along with the factors influencing price discovery, such as interest rates, creditworthiness, maturity, liquidity, market sentiment, and supply and demand. Before we get started, a quick reminder to download the essentials, the spreadsheet, the notes, and the slides. In this lesson, we're going to start tackling the quantitative aspects of bond valuation. In particular, we're going to see discounted cash flow analysis, which is the cornerstone of finance, especially for valuation methods. First, we're going to use Excel to build the basic model that helps us see the relationship between the time value of money and bond pricing. We'll need two elements. Basically, this is what we need all the time: the future cash flows and when they occur. And two, the appropriate discount rate to calculate their present value. The pricing of bonds revolves around the formula of discounted cash flow analysis that you're looking at now. Momentarily, using Excel, we'll use this formula to make some simple calculations. Let me explain what these symbols stand for. C is the coupon, N is the number of periods, or years in this case, before maturity, and R is the required rate of return. Now, let me show you my screen so that we can start working on Excel together. Firstly, the price of a bond is determined using a method known as discounted cash flow analysis, DCF. This means that the bond's value is equivalent to the present value of all the expected future cash flows it will generate. These cash flows include periodic coupon payments and the final repayment of the bond's face value at maturity. We need two elements to determine a bond's price: the future cash flows and an appropriate discount rate to calculate the present value. Let's begin with a first simple example. First, we outline the cash flow schedule, as I've done here, with periods representing the number of years when the cash flow occurs. You see, the first coupon, the second, and so on until maturity at the end of the fourth year when the bond is redeemed, and the last cash flow contains also the par value of the bond. Next, we have to find an appropriate discount rate representing the required return that investors demand for comparable bonds, in terms of risk. In this case, 4% is the discount rate we use to calculate the present value of the cash flows. I have chosen 4%. We'll see that it's not as simple as this to find the appropriate required rate of return. These letters here are for reference to these equations so that you can refer to. By referring to this formula for present value calculations, we have the bond's price is the sum of all cash flows on a present value basis. This other formula uses a shorthand summation symbol, and it's more compact to use. In cells F22 and G22, we have the present value of their respective cash flows. Note that in cell I22, we have the present value of both the face value and the last coupon. Note also the use of the dollar sign that I've used in the formula to compute the present value. It was used to copy and paste the formula using the same layout for the bond valuation below. I've used, as you can notice here, both the hand calculation in cell E24 and Excel's formula for present value, which we'll see shortly. What is 103.63? It's the bond price, or fair value, of a security with a 4-year maturity. This bond was issued before, probably a few months before or even a few years before, at 100. We don't know. We're now dealing with a bond with a 4-year remaining lifetime. This bond here has a 5% coupon, whose required rate of return is now 4%. The required rate of return should be the one observed on comparable bonds in terms of risk. Given the required rate of return, we use it now to discount the bond's cash flows to present value terms. These equations represent what we've done in cells E24 and F24. What happens if we change the discount rate? And why should the discount rate change? For example, if I change the required return to 2%, you should observe that we get 111.42. If I change it to 6%, we get 96.53. What's going on? Again, we're discounting these cash flows at different required rates of return. These are the fundamentals of the time value of money, which we're not referring to explicitly. However, paying a lower price for a fixed rate bond, as you notice, generates a higher return, and vice versa. A higher return requires a lower price. It should be straightforward. If you pay a higher price for something, in this case, this is a bond, given the future cash flows, then you'll get a lower return, and vice versa. Notice also that for a 5% required rate, the fair value or price, as we've called it, becomes 100. Now, if the coupon is deficient relative to the return required by investors, let's say, as in this case, the coupon is 5% and the required return is 6%, then the bond's price has to be lower than 100 to compensate investors for this deficit, and vice versa. If the coupon is in excess of the rate required by investors, our initial starting point was a 4% rate. This means investors are willing to pay a premium relative to the par value at redemption. Before moving on, let me highlight that we're looking at the price of a bond on a coupon date or on the issue date. We'll be removing this condition shortly, after a couple of lessons. Now, let's move to this other example down here. What we have here is the same as before, with the exception of maturity that is now 6 years. Let's assume again that the required rate of return is 4%, as I've entered here. Let's determine this bond's price by discounting the future cash flows from year 0 to year 6. We get a fair value or price of 105.24. As you notice, the price for this 6-year bond is greater than before. The reason has to do with the bond's maturity and the fact that the required rate of return is lower than the coupon. The coupon is in excess of the discount rate. Let's move to this other sheet here, where we want to compare two bonds with comparable risk, but that have different coupons, and where we're going to use the same discount rate. They are 6-year maturity bonds. We're still using both the hand calculation here in cell E25 and Excel's present value formula next to it in cell F25, even though it would not be necessary, just to show you how these calculations are carried out. As you notice, the price of this 3% coupon bond has a price of 94.76 if I compare it with a 5% coupon bond with a price of 105.24. The reason for this difference is the fact that the first bond is deficient in terms of coupon. To yield the same 4%, the bond has to trade at a lower price. Investors, by paying a lower price for a lower coupon bond, in this case 94.76, for this 3% coupon bond, will have the same return, that is 4%. We have just seen a fundamental feature in bonds pricing. That is the relationship among the price, the coupon, and the discount rate. In particular, we have uncovered the relationships summarized in this table. A bond's price is said to trade at par when its price is 100. This happens when the discount rate, which is a required rate of return, is equal to the coupon rate. The coupons are neither deficient nor excessive versus the required rate of return. When the coupon is lower than the discount rate, the bond is said to trade at a discount. The reason being that investors demanding a higher return will be willing to buy the bond for a lower price that compensates for the deficient coupon, and vice versa. If the coupon is higher than the discount rate, the bond trades at a premium, because investors will want to buy a bond with an excessive coupon versus the discount rate, up to the point when the bond's yield equals the required rate of return. Now, let's dive in a little deeper in this relationship by changing the required rate of return this time. It's more an exercise to understand better what's going on. You see, in the previous sheet, we compared different bonds with different coupons. In this sheet, we're ready to see what happens to a bond's price when we change the required rate of return. By using the same structure as before, what happens if we change the discount rate for this bond from 2% to 3%? We already know that. The price will be lower and will be 100. What happens if we raise the required rate of return to 4%? The price declines under the par value. Now it's a discount bond. We're starting to see that a bond's price is responsive to changes in the return investors require. Before wrapping this up, let me highlight always using the same structure here on this sheet for basically the same bond. What would happen if this time, instead of changing the required rate, we assumed that the price would change? I mean, in reality, when a bond's been issued and is traded on the markets, its features, meaning its stated coupon and its maturity, are given. And what changes on the market, what we see change on the market, are the prices. The question now is, what would the required rate of return be if the price declined? Well, it would mean that the required rate of return has become higher, and vice versa. If the price rose above par, for example, it would mean that the required return had become lower. Investors show their required returns by changing the price at which they are willing to buy or sell a bond. Obviously, the required return accounts for risk. Let's see this. Let's move to the next sheet. For this 5-year 5% coupon bond whose price is 110, we know from what we've previously seen that being a premium bond, the discount rate to get this price must be lower than the coupon. The logic that applies here is, if we buy this bond given its price, its coupon payments, and its time to maturity, what would the return be? You see, I just said the return without adding anything. 2.83%. You see, previously we called the required rate of return discount rate, or vice versa. Now we've inverted the logic. Given the price, what's the return? The return is called yield to maturity, and it's the rate of return required by investors willing to purchase this bond for its price, and is the discount rate used to calculate the present value of its expected cash flows. We'll dedicate a lot of time to yield to maturity in the next lessons, which are directly and indirectly dedicated to this very important concept of fixed income analysis. Specifically, we'll introduce yield to maturity in the next lesson. Okay, we've seen the fundamentals of bond pricing, and this wraps it up here. Don't forget to tackle the questions at the end of the lesson to strengthen your understanding. Also, make sure you've downloaded the slides, the spreadsheet, and the notes if you haven't already. They'll be really useful for your study and review. This will do for me, and I'll see you in the next lesson.